The ultimate inflation hedge guide, gold versus silver versus Bitcoin. Hey everyone, it's Scott and let's talk inflation. Specifically, how to protect your hard-earned money from it. We've all seen prices going up on everything from groceries to gas, and it can be scary to think about your savings losing value. That's where inflation hedges come in. Assets designed to hold their value, or even grow, when everything else seems to be getting more expensive. Today we're diving deep into 3 popular inflation hedges: gold, silver, and Bitcoin. We're going to break down what each one is, how it works as an inflation hedge, and what the potential advantages and disadvantages are of each. Whether you're a seasoned investor or just starting, this video is your ultimate guide to understanding these assets and how they might fit into your overall financial strategy. Now, I'm not a financial advisor, so this isn't financial advice, just me sharing some information that I find really interesting. But by the end of this video, you'll have a much better understanding of these 3 assets and be able to make more informed decisions about your own portfolio. So let's get started. Gold, the classic inflation hedge. Let's start with the one you've probably heard of, gold. For centuries, gold has been seen as a safe haven asset, something people turn to in times of economic uncertainty. Think about it, gold has been valuable since, well, forever. Ancient civilizations used it as currency, and it's still a major part of central bank reserves around the world. What makes gold such a reliable inflation hedge is its scarcity. There's a limited amount of gold on Earth, and it's not like we're creating more anytime soon. This limited supply means that gold tends to hold its value over time, especially when compared to fiat currencies like the US dollar. When governments print more money, it can lead to inflation, making your dollars worth less. Gold, on the other hand, is much more resistant to this kind of devaluation. Think of it like this. Imagine you have a pizza, and you cut it into more and more slices. Each slice represents a unit of currency. The more slices you cut, the smaller each slice gets, and the less each slice is worth. That's kind of like inflation. Gold, however, is like having a whole separate pizza that stays the same size no matter how many times you slice up the first one. Now, it's important to remember that gold doesn't behave like a traditional investment. You're not going to see the same kind of rapid growth that you might with, say, a tech stock. It's more about preserving your capital, protecting it from the erosive effects of inflation. So while gold might not make you rich quickly, it can provide a sense of stability and security in your portfolio, especially during times of economic turbulence. One of the main benefits of gold is its historical track record. We have data going back literally thousands of years showing how gold has held its value through countless economic cycles, wars, and even pandemics. This long-term perspective can be really reassuring for investors, especially when other asset classes seem volatile or uncertain. Another advantage of gold is its global recognition and acceptance. You can trade gold pretty much anywhere in the world, making it a highly liquid asset. This is important because it means you can easily buy or sell your gold holdings whenever you need to, without having to jump through a bunch of hoops. However, it's not all sunshine and rainbows with gold. One of the main drawbacks is that it doesn't generate any income. Unlike stocks that pay dividends or bonds that pay interest, gold just sits there. It's not working for you, it's just existing. Another potential downside is that the price of gold can be influenced by factors beyond just inflation. Things like central bank policies, geopolitical events, and even investor sentiment can all impact the price of gold, making it fluctuate in the short term. Overall, gold is often considered a cornerstone of a well-diversified portfolio, especially for those looking to hedge against inflation and preserve their wealth over the long term. But, as with any investment, it's crucial to do your own research, understand the risks involved, and determine if gold aligns with your individual financial goals. Silver, the industrial metal with inflation-fighting potential. Now let's move on to silver, often referred to as the poor man's gold. While that might sound like a backhanded compliment, it actually highlights one of silver's key advantages. It's more accessible to smaller investors. See, silver is significantly cheaper per ounce than gold, making it easier to buy and hold, especially if you're just starting out. But don't let the lower price fool you. Silver shares many of the same characteristics that make gold a good inflation hedge. Like gold, silver has a limited supply. It's also been used as a form of currency for centuries, giving it intrinsic value that stood the test of time. However, silver has another trick up its sleeve. Unlike gold, which is primarily seen as a store of value, silver has significant industrial applications. It's used in everything from electronics and solar panels to medical equipment and water purification systems. This industrial demand for silver adds another layer of complexity to its price movements. When the economy is booming and industries are thriving, the demand for silver increases, which can drive up its price. This means that silver has the potential to not only hedge against inflation, but also participate in economic growth. This dual nature, as both a precious metal and an industrial commodity, makes silver a fascinating asset class. If you believe that inflation will rise alongside economic expansion, silver could be a particularly compelling investment. It allows you to potentially benefit from both the rising tide of inflation and the growth of the real economy. Now, it's important to acknowledge that silver tends to be more volatile than gold. Its price can fluctuate more dramatically, especially in the short term, due to changes in industrial demand, supply chain disruptions, or even speculation in the commodities markets. This volatility can be a double-edged sword. On the one hand, it means that silver has the potential for more significant gains than gold, especially in a rapidly changing economic environment. On the other hand, it also means that silver can experience more dramatic price drops, which might not be suitable for all investors, particularly those with a lower risk tolerance. Another factor to consider with silver is its storage. Because it's less expensive than gold, you might need to purchase a larger physical quantity of silver to achieve the same investment value. This can present logistical challenges, especially if you're storing it at home. Overall, silver offers a unique combination of inflation hedging capabilities and growth potential. Its industrial uses provide a potential tailwind, while its lower price point makes it more accessible to a wider range of investors. However, it's crucial to be aware of silver's volatility and to approach it with a long-term investment horizon. Chapter 3: Bitcoin, the digital gold. Finally, let's talk about the new kid on the block, the one that's been making headlines and sparking debates: Bitcoin. Bitcoin is a cryptocurrency, a form of digital currency that operates independently of any central bank or government control. Now, I know what you might be thinking. Bitcoin? Isn't that incredibly risky and volatile? And yes, you're not wrong. Bitcoin's price has been on a roller coaster ride since its inception, experiencing massive surges and dramatic crashes. This volatility can be exhilarating for some investors, but it's definitely not for the faint of heart. However, there are reasons why Bitcoin is often touted as a potential inflation hedge, even with its volatility. One of the key factors is its limited supply. Unlike fiat currencies, which can be printed endlessly by governments, Bitcoin has a fixed supply cap of 21 million coins. That's it. No more, no less. This scarcity is built into Bitcoin's code, and it's one of the core principles that attracts many investors. The idea is that as more people adopt Bitcoin and its supply remains capped, the value of each Bitcoin should theoretically increase over time, especially if demand continues to outpace supply. This is similar to how the scarcity of gold and silver contributes to their value propositions. Another factor that makes Bitcoin appealing as a potential inflation hedge is its decentralized nature. Bitcoin operates on a global network of computers, not controlled by any single entity. This means that no government or central bank can manipulate its supply or devalue it through inflationary policies. However, it's important to be realistic about Bitcoin's current limitations. While its adoption has grown significantly, it's still not widely accepted as a form of payment for everyday transactions. You can't yet walk into any store and buy groceries with Bitcoin, although this is slowly changing. This limited acceptance makes Bitcoin less useful as a currency in its current state, which can impact its value. Another challenge for Bitcoin is its regulatory landscape, which is constantly evolving and varies significantly from country to country. Some governments have embraced Bitcoin, while others have imposed restrictions or outright bans. This regulatory uncertainty can create volatility and make it difficult for institutional investors to fully embrace Bitcoin. Finally, it's crucial to remember that Bitcoin is a relatively new asset class. It's only been around for a little over a decade, which is a blink of an eye in the grand scheme of financial markets. This lack of historical data makes it difficult to predict how Bitcoin will perform over the long term, especially during major economic downturns or periods of high inflation. Despite these challenges, Bitcoin has captured the attention of investors worldwide and sparked a broader conversation about the future of money and finance. Whether it will ultimately live up to its potential as a digital gold remains to be seen, but it's definitely a space worth watching closely. So there you have it. A rundown of 3 popular inflation hedges: gold, silver, and Bitcoin. As we've seen, each asset has its own strengths and weaknesses, and the best choice for you will depend on your individual financial circumstances, risk tolerance, and investment goals. Gold, the classic safe haven asset, offers stability and a proven track record of preserving wealth over centuries. Silver, with its dual role as a precious metal and industrial commodity, provides a blend of inflation protection and growth potential. Bitcoin, the volatile but intriguing newcomer, represents a bet on the future of finance and a decentralized monetary system. Ultimately, the best approach to inflation hedging is to diversify. Don't put all your eggs in one basket. Consider allocating a portion of your portfolio to each of these assets, adjusting the proportions based on your own assessment of their risks and potential rewards. Remember, knowledge is power, and by understanding these assets, you'll be better equipped to navigate the complexities of inflation and safeguard your financial future. Thanks for watching.